Welcome back to the deep dive. Today we're taking a pretty monumental journey back to the height of Japan's economic supremacy and, well, its subsequent downfall.
That's right.
We are diving deep into the Japanese asset price bubble, known locally as the Baburu Keiki. And this wasn't just some, brief market frenzy.
No, not at all.
We're talking about a 5-year period stretching from what, roughly 1986 to 1991.
That's the one. A period where the values of, well, almost all assets, but especially commercial real estate and stocks, just became completely disconnected from reality. It was, like you said, a kind of economic hallucination.
A hallucination. That's a great way to put it.
And it was one sustained by incredibly cheap credit and just this collective belief that it could never end. But the consequences, as we now know, were just devastating.
Right. Because when that bubble inevitably burst, starting in what, early 1992?
Yes, that's when the crash really hit. Japan was left grappling with this mountain of non-performing loans, NPLs, that basically crippled the entire financial sector.
And that ushered in the era we all know as the lost decade.
Or decades, really.
Exactly. So our mission for you today, based on the material we've both been digging into, is to move past that simple narrative of Japan just got too rich.
Right.
We're going to really dissect the specific mechanisms that built this thing. We'll look at the staggering scale of the inflation, this intricate web of causes. I mean, everything from global policy deals
Like the Plaza Accord
to these deeply entrenched domestic tax loopholes. And then finally, we'll trace the decades-long shadow this collapse cast over the entire Japanese economy.
And just to, set the stage properly, when we talk about the Baburu Keiki, we're looking at a classic asset price bubble. It has 3 core elements.
Okay.
First, you have rapid asset price acceleration. Second, an overheated economy in general. And third, and this is the critical one, an uncontrolled expansion of both the money supply and credit.
And the engine for all that?
The engine was policy. Specifically, an excessive monetary easing by the Bank of Japan, which made speculation not just easy, but almost irresistibly profitable. It fundamentally destabilized the whole market.
Okay, let's unpack that. But before we get into the policy failures, we have to understand the scale. I mean, just how distorted did these prices actually become?
Yeah.
We really need to look at the numbers to appreciate the sheer magnitude of this frenzy.
The magnitude is, it's genuinely hard to overstate. And it's important to remember that while this was a national event, it wasn't evenly spread.
Right. It was highly concentrated.
Very. The inflation varied dramatically depending on city size and, how close you were to the big economic centers, especially Tokyo and Osaka.
And our sources really focus on the epicenter of this. The 6 major cities defined by the Japan Real Estate Institute. So that's Tokyo, Yokohama, Nagoya, Kyoto, Osaka, and Kobe.
These were the core hubs, and the data from these places is it's staggering.
So let's start with commercial land. That was the primary target,
Yeah,
right?
absolutely. Corporate speculation was all about commercial land. By 1991, at the absolute peak of the bubble, commercial land prices in those 6 cities had skyrocketed by, get this, 302.9%.
Wow.
302%.
Compared to 1985 levels, that's more than a 3-fold increase.
It's just 6 years.
Just 6 years. And residential land, where ordinary families lived, that also saw a massive jump of about 180%.
That velocity is just dizzying. This isn't slow, steady appreciation. It's a geometric explosion. And if we drill down even further into Tokyo, the financial heart of it all, the data shows this hyperacceleration that almost defies logic.
It does. Demand for office space in the major commercial districts was, for all intents and purposes, limitless.
And you see this reflected immediately in the pricing, right? That jump between 1985 and 86.
That single year is the perfect example. The average price per square meter for commercial land in Tokyo jumped 122%.
In 1 year. 1 year. To put numbers on that, it went from about 1.9 million yen in 85 to 4.2 million yen per square meter in 86. Residential land in Tokyo shot up 45% in that same 12-month period.
It's fascinating how quickly the mania just spilled over.
Yeah.
Because once central Tokyo became too expensive, even for the speculators, it just moved out into the periphery, didn't it?
Immediately. You see the adjacent prefectures, Kanagawa, Saitama, and Chiba, the greater Tokyo area, they become the next big targets for investors between 88 and 90.
And this wasn't just a Tokyo story.
Oh, not at all. Osaka, as a commercial center, often had urban land prices that were even higher than many parts of Tokyo. I mean, in 1986, Osaka commercial land jumped 35% in 1 year. Kyoto and Kobe also saw gains over 20–30%. So the credit and the speculation were truly national phenomena.
Which brings us to the most iconic, if slightly absurd, example of this whole thing. We have to pause on the anecdote about the Tokyo Imperial Palace grounds.
Yes, you have to. It provides that kind of visceral, necessary context.
So, at the peak of the market,
At the very peak, the estimated value of the land occupied by the Tokyo Imperial Palace, which is about 1.15 square kilometers, was said to be worth more than the entire real estate value of the state of California.
let that sink in for a moment. An entire, vast, productive U.S. state.
With all its cities, infrastructure, agriculture, everything.
It was worth less than a few acres in central Tokyo.
That one data point just crystallizes how completely detached from reality these values had become. It wasn't investment anymore. It was pure, unadulterated speculation, all built on the belief that the government would never, ever let prices fall.
Okay, so let's connect the land to the stock market, because this was the unified bubble, wasn't it?
Absolutely. The dirt and the digits, they were inextricably linked. The rise of the Nikkei 225 index was not happening in a vacuum.
And it's really key to understand that correlation. In the Japanese system back then, when land values went up, it automatically increased the net assets of major corporations, which were huge landowners.
Right. And that, in turn, drove their stock prices up, almost regardless of their actual business performance or earnings. Investors weren't really buying company performance. They were buying appreciating land holdings on the balance sheet.
And the climb of the Nikkei 225 just tells that story of self-reinforcing confidence.
It does. Between January 85 and its all-time high, 38,957, on December 29, 1989, the index gained over 224%.
224%. It was just a relentless climb that seemed to defy gravity, especially after it broke that 30,000-point mark in '88.
But the sources suggest there was something deeper going on with corporate behavior that made the market even more brittle.
You're talking about the cross-ownership and the trading patterns.
Exactly. You see this significant shift in who was actually buying and selling the shares. Corporate trading volumes just grew massively, rising from 19% of the market to 39% during the decade.
And at the same time, you had the traditional keiretsu system, these interconnected corporate groups.
Right. Which meant cross-ownership, where companies hold shares in each other to maintain relationships. It just ballooned. It went from around 39% in 1950 to an incredible 67% in the 1980s.
Wait, hold on. If nearly two-thirds of all shares are locked up in these cross-holdings and corporate trading is soaring, that means the actual floating supply of shares for public investors is shrinking fast.
Precisely. And that limited float meant that prices were inherently easier to manipulate, and it points to a really serious flaw in corporate governance.
How so?
Well, when companies are more focused on inflating their balance sheets with appreciating land and supporting their keiretsu partners, they become completely detached from their main job, which is delivering shareholder value through their core business.
So the stock market was basically a derivative of the land market. As long as cheap credit flowed, land prices rose, and stock speculation just continued like nothing could stop it.
It was a perfect storm.
Okay, now that we've set the scale, let's get into the complex policy environment that made it all possible. This didn't just happen out of nowhere. It was kicked off by a series of interconnected decisions, and they started not in Tokyo, but with international demands. This is where it gets really interesting.
The initial policy lever was pulled in September 1985 with the signing of the Plaza Accord in New York. This was an agreement between the G5 nations, Japan, the U.S., West Germany, France, and the UK.
And the main goal was to fix America's trade deficit, right? By weakening the U.S. dollar.
That was the core objective. The U.S. needed its goods to be cheaper overseas to boost exports. And Japan, with its massive trade surplus, had a weak yen that was making Japanese exports hyper-competitive.
So the G5 nations agreed to coordinate and intervene in the currency markets.
The mechanism was pretty simple. The central banks just started aggressively selling U.S. dollars. This created a huge demand for the yen, forcing its value up.
And the effect was immediate.
Immediate and overwhelming. The yen appreciated fiercely. It rocketed from about 238 yen to the dollar in 85 to 165 by 1986.
That is a massive currency shift in a very short time. What did that do to Japan's domestic economy?
It triggered what was known as the Endaka recession, a recession caused specifically by that dramatic appreciation of the yen. Japanese export profits were they were crushed almost overnight. GDP growth, which had been a healthy 5.2% in 85, slowed sharply to 3.3% in 86.
So the Bank of Japan was suddenly in an impossible position. This internationally mandated currency strengthening was killing their export-led economy.
Exactly. Their only immediate tool to stimulate the domestic economy and offset that was to just flood the market with cheap money.
They had two choices, right? Let the recession get worse
Or undertake aggressive fiscal stimulus and, most critically, aggressive monetary easing to compensate. They chose the latter, and that decision ultimately lit the fuse for the bubble.
And the BOJ's reaction was historic.
It really was. They cut the official discount rate in 5 rapid-fire rounds. It started at 5% in January 86 and was systematically slashed until it hit a historic low of 2.5% by February 1987.
And that ultra-low rate stayed locked in place for over 2 years, until May of 89.
It did.
But hold on. Japan recovered from the Indaka recession pretty quickly by early 87. So why did the BOJ keep the rate so low for so long? At 2.5%, money was practically free, and asset inflation was clearly starting to pick up.
And this is the major point of criticism against the BOJ, and it ties directly back to that international pressure from the Plaza Accord.
I see.
Our sources suggest that after that first cut, the next 4 rate cuts were heavily influenced by international policy goals. They were often announced jointly with the U.S. or the G7, and their main focus was preventing more currency fluctuations.
So the priority was keeping the exchange rate stable, not controlling domestic asset prices.
That was it. So even when policymakers in Japan realized that asset inflation was accelerating in 87 when they saw those real estate prices we just talked about, they felt their hands were tied by that international commitment. The BOJ even briefly considered tightening in the summer of 87. They saw the problem. But they delayed, first because of those currency stability demands, and then Black Monday hit in October 87.
Which triggered another global wave of monetary easing.
Exactly. Tying Japan's hands even further, they were so focused on looking outward while their own domestic economy was just internally boiling over.
So what was the measurable effect of all this? What happens to liquidity when you hold interest rates at 2.5% in a rapidly recovering economy?
The money supply it accelerates rapidly and becomes uncontrollable. The M2 plus CD growth rate, which was around 8% in 86, shot past 10% by the end of 87 and peaked around 12% in early 88.
So you have this tidal wave of cheap money.
A tidal wave of cheap money that needed a home, and that home was land and stocks. The amount of funding provided to companies and households just surged, hitting a peak growth rate of almost 14% year-on-year in 1989. This ease of credit was the absolute foundation for the bubble.
So the BOJ provides the fuel, the cheap money. But financial deregulation provided the pipes for that money to flow directly into speculation. Tell us about that shift in bank behavior in the 80s.
Well, this deregulation, much like the Plaza Accord, was partly driven by pressure from the U.S. The U.S. was pushing Japan to liberalize its financial markets.
How did that specific modernization step lead to speculative lending, though?
It created a kind of crisis for Japan's commercial banks. See, traditionally, their main customers were large, stable corporations. But once the ban on raising funds in the securities market was lifted around 1980, those big, creditworthy firms started bypassing the banks.
They went straight to the bond and equity markets.
Exactly. And that severely shrunk the bank's safest and most profitable customer base.
So the banks got squeezed. They had to pivot to riskier clients to maintain their profits.
Precisely. They shifted aggressively. First, they promoted loans to smaller firms, which were riskier but offered higher returns. And crucially, these loans were overwhelmingly secured by property collateral. Then, at the height of the bubble, 87, 88, banks started lending aggressively even to individuals, again, based on property values. The sources note that even an ordinary salaried worker could easily get a loan of 100 million yen if they just had a house to put up as collateral.
And that creates the catastrophic feedback loop, doesn't it?
The classic one.
Cheap money fuels speculation. Rising land prices increase the collateral value of assets you already own, which expands your borrowing capacity.
So you can borrow even more cheap money to buy more assets, which drives prices even higher. It's a self-reinforcing, credit-backed cycle, and the banks were willingly feeding the beast.
Okay, so the external policies lowered the cost of entry, but it was the internal laws that made holding onto these assets, specifically land, irresistible. It practically mandated speculation.
It really did. Let's start with the tax system. Japan had these notoriously high inheritance taxes up to 75% before 1988.
Which is a huge incentive to find a loophole.
And the loophole was built right into the rules for asset appraisal. For inheritance tax, land was often appraised at about half its actual market value. But debt was considered at face value.
Okay, walk me through the financial logic there.
If you're a wealthy individual and you're facing a 75% tax on your estate, the most rational thing to do is borrow a huge sum of money against your appreciating land.
Okay.
You use that loan to buy more land or other assets. When you pass away, the government appraises the land at half its market value, but they deduct the debt at its full face value. You effectively shrink your taxable estate through borrowing.
So you're borrowing cheap money, not for productive investment, but just to slash your tax bill.
Essentially, yes. The tax system was subsidizing borrowing and asset hoarding. And on top of that, the actual cost of just holding the asset was, well, it was negligible.
This is the second major distortion, right? The low property tax rate.
Shockingly low. The official statutory rate was 1.4%, but in practice, the valuation system was so slow and undervalued that the effective rate just couldn't keep up with soaring market prices.
How low did it get?
In the greater Tokyo area, the effective property tax rate dropped to a stunning 0.06% of the market price.
0.06%. That number is it's crucial.
Yeah.
Why is that so devastating?
It means if you owned $1 million piece of land, your annual holding cost was $600.
Right.
When you combine that with an almost guaranteed expectation of massive price increases, remember, values were tripling in 6 years. It becomes absolutely irrational to use that land productively. It was far more profitable to just sit on it and reap the capital gains than to build anything.
And this was all compounded by the old land lease law.
That law, which was meant to protect tenants, actually created artificial scarcity. It was almost impossible for landlords to regain control of their property or redevelop it. Rents were kept artificially low by the courts.
So if you're a landlord, you have zero incentive to rent or develop.
None. The rational choice was to refuse to rent, leave the land empty, and wait for those tax-subsidized capital gains. It was a vicious cycle that drove prices even higher.
So Japan created a system where international pressure forced cheap money, deregulation funneled it into property-backed speculation, and domestic laws made hoarding assets the only rational choice. The bubble was built on quicksand. Now let's talk about the end.
The crash was predictable, but the timing and the sequence were really crucial. It wasn't instantaneous. It started with monetary policy, hit stocks first, and then finally crushed real estate.
The Bank of Japan finally realized the scale of the problem. But by the time they acted in 1989, it was way too late for a soft landing, wasn't it?
Far too late. They had to tighten aggressively. The BOJ started hiking the official discount rate in May '89 from that low of 2.5%. They did 5 rounds of tightening, rapidly moving the rate all the way up to 6% by August of 1990.
That's a massive 350 basis point hike in just over a year, a staggering reversal.
It was designed to instantly pull all that liquidity out of the system.
But was it too much? Too late? Did that panic reaction just guarantee a crash?
That's the core debate. Many argue that by waiting so long, the BOJ had no choice but to slam on the brakes. And when lending costs shot up that dramatically, the entire speculative debt machine just seized up.
And the stock market, being the most liquid asset, it reacted first.
Almost instantly. The Nikkei 225 just tumbled throughout 1990. It was a catastrophic drop. The index went from its peak near 38,900 down to just 21,902 by December.
That's a loss of over 43% in a single year.
In 1 year. The stock market had officially collapsed by the end of 1990, and it just kept falling.
But the real estate market, being so illiquid and culturally central to wealth in Japan, it took longer to face reality, didn't it?
It showed that characteristic lag. The first serious warning signs appeared in '89 when residential land prices in some Tokyo areas dipped by a tiny 4.2%. The market mostly ignored it.
But the official widespread collapse wasn't really acknowledged until '92.
Right. That's when the price drops became systemic and widespread. In 1992 alone, Tokyo commercial land prices fell 13%, and residential fell 19% compared to the year before.
And the total value that was wiped out was just astronomical. But it's the long-term decline that's truly shocking.
It is. The prices just kept falling for over a decade. By 2004, more than 10 years after the crash, prime commercial properties in Tokyo's financial districts had slumped to less than 1% of their peak value.
1%.
A 99% loss. This wasn't a correction. It was a generational destruction of asset value that completely redefined wealth in Japan.
And that collapse didn't just end a speculative frenzy. It created a chronic economic illness. It fundamentally reshaped Japanese society for decades, leading to what we now call the lost decades.
Right, the term lost decade was coined for the 90s, but as we know, it stretched into the lost 20 years, maybe even beyond. Japan just never regained that sustainable, robust growth.
The GDP figures really lay it bare. Japanese GDP in 2017 was only 2.6% higher than it was 2 decades earlier in 1997.
That's an annualized growth rate that is functionally zero. The prolonged collapse of asset prices just triggered this profound loss of confidence. When every asset you own, your stocks, your home is losing value year after year, it shatters consumer psychology.
And shattered confidence leads to
Deflation. Consumers became deeply uncertain about the future, their pensions, their jobs. Their main reaction was to save, not spend. And this persistent weakness in demand led to a long-term deflationary spiral that was poison for a debt-heavy economy like Japan's.
The core issue was that corporate balance sheets were just saturated with debt backed by worthless collateral.
And this leads us directly to one of the most toxic legacies of this whole era, the rise of the zombie company.
The term is so visceral. Can you define what a zombie company is in this context?
It describes Japanese firms that were, for a long time, economically unviable. They couldn't generate enough profit to even cover their debt payments. They should have failed.
But they didn't.
They didn't. The government and the banks, fearing a catastrophic financial collapse, just kept cropping them up through sham loan restructurings and regulatory forbearance.
And what was the economic consequence of keeping these firms alive? Why did it drag down the whole economy?
The systemic cost was immense. These zombie companies tied up capital that should have been redirected to more productive parts of the economy. They depressed prices, reduced profits for healthy firms, and critically, they just crushed job creation and lowered overall productivity.
Because they kept their older workers, starving newer, more competitive sectors of both capital and young talent.
Exactly. The attempt to save the failing companies ended up crippling the successful ones. Meanwhile, the entire financial sector was drowning.
Paralyzed by these huge non-performing loans.
Absolutely. The crisis claimed major victims. We saw the failures of Hokkaido Takushoku Bank and Yamaichi Securities in '97, and then the Long-Term Credit Bank of Japan in '98. The very structure of Japanese finance was undermined.
And this paralysis in the financial system led to the rise of the carry trade, didn't it?
It did. With the Bank of Japan forced to keep domestic interest rates near zero, it created this massive interest rate differential with the rest of the world.
So investors would borrow yen for next to nothing,
and immediately exchange it for dollars or another currency to invest in higher-yielding assets elsewhere. They were profiting solely on that interest rate spread. It was a symptom of the domestic economy's complete inability to find profitable investments.
And on the human level, the cherished lifetime employment model was another casualty.
Profoundly so. As firms struggled for decades, that social contract was abandoned. The lost generation of college graduates in the 90s and 2000s couldn't find stable work, which created lasting social inequality and wage stagnation.
The government tried to intervene, but their initial responses seemed to miss the mark. Let's talk about the fiscal response.
Starting in '93, they tried massive fiscal stimulus, pouring money into public works, but it failed to deliver the intended boost.
Why not?
It's a classic liquidity trap. Consumers and corporations were so uncertain that they just saved the money or paid down debt rather than spending it. The government's efforts to stimulate consumption were just completely overridden by shattered confidence.
So the stimulus just ballooned the deficit.
Yeah.
This led them to switch back to monetary policy with the zero interest rate policy, or ZRP.
Yes, the central bank cut the nominal interest rate as close to zero as possible by the late 90s. The idea was to make borrowing so cheap that companies would be forced to invest.
But that wasn't immediately successful either.
No. Again, uncertainty beat low costs. Companies didn't see enough profitable opportunities to justify taking on new projects, even at 0% interest.
So what eventually did help stabilize things?
According to the analysis, the better policy was quantitative easing, or QE, introduced in 2001. QE is different. It targets the quantity of money available in the market.
Explain that for us.
The BOJ essentially flooded the banking system with reserves, buying up government bonds to inject capital directly. The goal wasn't just to lower short-term rates, which were already zero, but to lower long-term rates and convince the market that money would stay cheap for a long time. That slowly helped stabilize the system.
Finally, we can't end this without talking about the corruption the bubble exposed.
Absolutely. The speculative frenzy was just lubricated by widespread bribery, insider trading, and stock manipulation.
The prime example being the recruit scandal of 1988.
That scandal was explosive. It involved a company offering shares to politicians and bureaucrats before they were publicly listed, allowing them to profit enormously.
And the political fallout was huge.
It implicated the entire cabinet of the prime minister, forcing him to resign. It brutally exposed the cozy, entrenched relationship between government and the private sector and showed that political favors were essential to the system that inflated and then burst the bubble.
What a profound and complex story. To summarize then, Japan saw this dramatic, unsustainable asset inflation, engineered primarily by the Plaza Accord, forcing the Bank of Japan into aggressively cheap money policies.
And that cheap money combined destructively with deregulation, high-risk lending, and these broken domestic laws like the inheritance tax loophole and the minuscule property tax that made speculation the only rational choice.
The result was the catastrophic collapse. The Nikkei down 43% in 1 year, followed by that devastating multi-decade real estate decline. The legacy is the lost decades, defined by deflation, shattered confidence, and the systemic drag of those zombie companies.
I think the key insight the Japanese bubble offers us is that economic policy driven purely by external concerns, like stabilizing a currency, can have devastating domestic consequences if you ignore the structural flaws at home.
And our source material really highlights how government support for failing institutions created those zombie companies that dragged down the entire economy. This raises a crucial question for you, the listener, to think about when you look at modern economies.
You have to ask, what long-term economic structures are being propped up in today's world, maybe through perpetually low interest rates or sustained government bailouts, that are functionally operating as zombie structures? What hidden systemic liabilities are being created today for future generations by supporting entities that maybe should be allowed to fail, just like the NPL crisis that defined 1990s Japan? That legacy is something that warrants some very deep contemplation.